It's time for another sector review. Let's start with the XLF. That's the banking sector ETF. So looking out from, it seems like yesterday when we drew this set of circumstances and they overdid it already. They didn't even dip to take the running start. They just plowed right through. This is a 20% rally nonstop. It was helped, wind aided, as they say, by the comments, the very dovish comments from the Federal Reserve. They basically said they're done raising rates. Not only that, they committed to cutting 3 times next year if you do the math between their targets on the overnight lending rates. Okay, Fed's funds rate. So if you look left, you're going into a prior fail or 2 or 3 or 4 or 5 or 6 or 7. So getting here is one thing, and getting through here, I think, will be something else. There should be sellers above 38, going into 38. The markets are at all-time highs. The Dow, the Qs, and the SPY is toying with it. The only laggard is the small caps, IWM, RUT. And they're about to break out from their zone. If the IWM breaks out, I would imagine the S&P also takes out a new all-time high, and this one might run a little bit higher. But for me, as an investment, I wouldn't start any longs here. So if we go into shorter time frames to get some levels, there's not much. It's up, up, and away. They're buying every dip that they can see. So for example, the next day when the market opens, we would have a trigger at 37.80. That would take us to 38.60 or 38 or almost 39. We will immediately test my theory that we should have sellers above 38. This is a zone because it's pretty old. If I look left, I have to look left too far for me to find a proxy. So I can't rely on it to be surgical. It's long in the tooth. Not a reason to short, but it's definitely not a reason to pile into new longs. Tactical trades still work if you know what you're doing. I can short against the prior fail and stop out if it's gone. And the idea is to come down to here. And if they lose the support at 37.2, then I would definitely book that profits anywhere below 36.90. And then try to do it again. So they are buying dips. Dip bought. Dip will probably be bought and get to 38.10. So the strategy would be to short up here at 38.20 or 10, or short here with a stop, and or get long if they lose this. So you can play both sides. Short, book profits, get long, try to get up to here, get out. A lot of things to do. Everything is tactical. We'll go to the energy sector. Now, the energy sector is the only one that actually was under fire from that perspective because the U.S. is pumping at record levels, and they too got some relief. We have had 8 bullish weeks in a row, which I believe is a record if we actually finish it. We still have 3 days to go, so let's see what happens. Into 86, there should be sellers. That's the top line vision. However, this green M you see could get it up to 87, maybe even 89, 88.5. Meanwhile, you do have to contend with these levels I just mentioned. If we zoom in at 120, we do have sellers at 86. You can see them right there. And we do have buyers below. So we've established buyers. 83.50, there should be buyers. So if I want to be long on dips into 83.50, I can set my stops low enough to where they can go a little bit lower, come back and see if they can take that out. I could be long here, but it would be better on a dip. So going long here, the hope is to get out of the $86 lid to get $1.50, maybe even $2 out of it, and I would exit anywhere near 88. Now, the bears would want to see it continue lower lows and lower highs. And they would be right, assuming that, because that's what's been happening. So the bearish play on this one is shorting against 86 and then stopping out if above whatever level or above the pain tolerance that the trader might set for themselves. The idea is if I buy a put here and I may get the sell the rally mode. Rally sold, and each one sold made a new lower low. Rally, will it be sold and will it make a lower low? So it's worth playing the downside here as well. The utilities, now these are notorious for, no, they're known for paying dividends, right? And if the yields on in the market fell, that means their prognosis got better because they've been under fire because the Fed is jacking up rates. So the alternative trade surfaced. Suddenly, you could lend the government money on a 10-year, and you can get 5 or 5.25 on a 1 year, on a 2 year. Same thing, 5.4, I think, on the 1 year or 1 month. But that has dropped since the Fed's dovish statement. So they too got levitation. They are buying dips inside of an ascending channel. Now, getting to here is one thing, getting above here is something else. I have to tell you that this 66.50 looks like a giant wall. What will it take to take that out? Okay, so they will need some sort of a catalyst, because that looks pretty steep. So I think there are sellers at 65 through 66.50. Shortable, I think. If we rally into that, I would fade it. If I'm long here, I get it. There is support. Just like there are sellers, there's a lot of buyers down here, especially through 61.50. So if somebody's long here, if they get a rally into 66, I would consider that a tactical long, and I would book my profits. I don't know if it continues much higher, so be careful overstaying your welcome in a winning trade. XHB, now I get it. Now I've been saying I don't get it. I don't know why these stocks are rallying, right? So then the news of the Fed news hit them square in their advantage. So that concept just took off. I personally would not trade it because I'm missing piece of the puzzle. This did not work. The fade never showed up, and the headlines from the Fed definitely did not hurt. Now they're up in the stratosphere. What are you going to do? Go short? That's crazy, even though it's crazy high. So first bearish trigger is losing 93.2, 93.1 if you want to leave a little barrier, and of course the higher high. But this is there's nothing up here to short against except that one. So if they take that one out at 96.6, I would just give up on it. Gap here. So this is not great base, but look, they're full of them. So at some point this trade has to end, right? I'm not going to be the one that's going to time it. XLB, the material sector, let's zoom out to see where they're at. This one you could short because you do have proxies to the left. If you look left, every time it's been here, the last 4 times it's been here, it's been a disaster. So if somebody's starting trades here long, they're pushing their luck. They could argue that, oh, this is a breakout, and they'd be right. There's an inverse head and shoulders out of 84. That would probably point to 92. The distance is that much up from here, so almost 10 points of upside from here. Okay, so it is possible, but it's pushing your luck because these are 3 days of failures, 4 days, and whatever period of time here, a couple of weeks battles. So be careful. I would be careful starting longs blindly here. Short term, this is the trend: higher highs and higher lows, going against that prior fail. So buy the dip. You would be playing the trend with an opportunity to curl up and take out that high. Now, if the market rallies, of course, this one will go up. We are going into the end of the year. Everybody is optimistic. There's no worries out there. Suddenly, all the problems in the world have been solved, when in reality, only one may have been solved, and that's the Fed. Okay, so the geopolitical risks are all there. At some point, somebody say, let's take a breather. Don't short it, just buy the dip into this ascending channel. So if we get the opportunity to go long into this big candle here, that makes sense because that's what's been going on. Higher highs and higher lows. XLC were pretty aggressive the last couple of days. One could say they're breaking out. Target unknown because there's nothing close by to serve as a really good target gauge. The way I see it, they rallied from here, which is 60, to here, which is 69, and then they chopped around with the top at 69, and then they broke out from 69. So one would imagine that they have at least $4 above 69. So 73 to 75 would be the target, in my opinion, not some sort of a bowl of a cup and handle that aims at, I don't know, 100. So these are prior fails. You should respect that. There's a gap up above at 75. Markets love to fill gaps, especially if we're going up into them and we're getting close to them. So I wouldn't be too bearish here. I would enjoy the long, and I would time my exit. On the 30-minute, I don't know if we can get anything. Nope, higher highs and higher lows. There's not much more I can tell you. I can give you more accurate levels, 71 and 70.6. Good bases. The base of this candle and the base of these two. Those are good, solid support. XLK, it's been wild. Today it did some wild stuff. And if you were in the live room, you saw that. We had a crazy dip in the middle of the morning before the market opened, and then it disappeared and then went to higher highs. So in here, I think it's a lot of Microsoft and Apple. I'm going from memory. I think AVGO, Broadcom is in there big time as well. Path today went crazy late in the day and took it to higher highs. So there are some things going on that are system wide. So everything is breaking out. This one, I would say, broke out from 152. And the breakout from 152 was 34 points, which is somewhere around here. So they're overdoing it. But hey, with the help of AVGO and all the tech and all the tech concepts that are rallying right now, I wouldn't want to be the one shorting it. So you're either long or you're just watching for a dip to buy. Here's a harmonic you can trade with a stop. So this harmonic is a tradable dip towards, if you squint, you can see it, 50-cent dip, if you're lucky, $1, and the stop out point is 193.1 or 193.2. So if you go above 193.2, this red thing is not tradable. So micro dips, if you're good enough. If somebody's looking to short this, I would suggest looking into learning how to do diagonals. So I would buy a put diagonal in this just so I can be bullish short term, bearish long term, just to give them time to get out of this mega bull run. XLI, are you bored yet? I'm bored because these concepts are all the same. Here we are breaking out, and I wouldn't do this and I wouldn't do that. But that's how it is. That's how the market is going into all-time highs. Hard to believe that just a few weeks ago, everybody was scared crapless, and now up, up, up and away. The breakout was from 106 in general, and then they came back, established good footing, and they went through it like it wasn't there. So this is a pretty powerful push. They are buying dips, higher lows, higher highs on the daily, and I bet you if I log into, go into lower time frames, I would find the same stuff. What do you do with this? It's hard to trade this. No, let me rephrase. It's okay to trade it with momentum. It's hard to invest in it. I don't have a lot of conviction that if I buy into a full-size position here, that I'm going to make money in the next 6 months. But I'm also sure that if I short it, I'm going to lose my you-know-what on it, right? So they are rinse and repeat scenarios. So don't short it. You might end up getting walloped. So let's go like this, right? So they're like step action. You see how that is repeating? It's wow, look at this one and that one. They're virtually identical. That's pretty crazy stuff. Let's leave it here for a visual reference. Just aim for 116, however you want to get there. You want to be long from now, that's fine. You want to buy the dip, that's fine. XLY. Need I zoom out? I mean, rinse and repeat. This one you can almost measure what the measured move is. This broadening wedge is breaking out. It's probably going to 197. And if I look left, it will have to contend with this. So I would say I would exit at going into 192. There should be sellers. 190 to 192, there should be sellers. This cluster of tails. Why? Those are sellers. They're right there. I'm not making an opinion, but those are sellers. Now, inverse head and shoulders, broadening wedge, whatever, target much higher. So rest, drop, come back and finish the job. That's a possibility. Again, tactically, there's not even anything I can do here unless I'm day trading. And, or I just plug my nose and just hope for the best. And this is the mystery sector, the consumer staples. So this was a telltale sign. I kept asking, if we're going into a recession, why is the discretionaries running and the consumer staples like Pepsi and Coke are not? You'd think people would ditch the staples last, right? They're the cheapest and they're the ones we use to just enjoy on the go, like Pepsi, Coke, and they're falling out of control. They were, and they finally caught up. Well, this is a bearish setup for them. They're going into a prior fail. 72 to 73 was not a happy time for them. In fact, this is a place where I would think that they're going to have a difficulty cutting through. This is where they pivoted. Support, no, yes, no, finally fell below, and here they are coming back. So maybe they're here. Maybe they're lucky, they dip and they do that again. I'm not sure. So maybe we can copy this for a proxy from here to here and see if we can come up with that one. Okay, Nick. Come up with that one here somewhere. So maybe they can do that. Dip a little bit, come back and finish the job. Maybe. We'll see. There are some good companies in there. This red thing says buy the dip when it comes to 70. So 70 is available. If you twist my arm, I would try to target this. and the stopping point would be somewhere around 74. I say somewhere around because I'm getting two numbers, so I'm going to go with 74.1. That would invalidate this. Actually, I'll drop it a little bit lower so we don't ride it too high. Invalidate this red W. That gives me that white arrow. All right, XLP. Maybe that's the weakest one. Actually, let's go down to 15 minutes. Okay, you can see sellers at 72 right there. Buyers first, then sellers, and they change their mind. So let's see if they can cut through 72. I'm going to put an alert here for myself. All right, XLV, healthcare, also bearish setup. It's not a bearish price action. Clearly, it's just rallied umpteen percent. But this red thing says go look for reasons to short. Go look for reasons to short. Don't short blindly, which means you can short against this high with a stop. The stop should not be higher than here. And that's target 1. Target 2 is down here, but let's focus on target 1 and then see what happens. Almost identical to the other chart. The sellers are at 135.6 and 135.8. All right, XBI, similar concept, but these are biotechs. Oh boy, that's pretty exciting. So they're going into a prior fail, 2, 3, 4, 5, 6 times, whatever. If they take those fails out, they go to 105. Now, I'm going to guess that they should rest a little bit before they do that. But what am I talking about? Red day? We haven't had a red day in so long. They just rallied 35%. This is a tough short, just like the rest of the market. All right. Short term, we don't have any proxies. The high of the day, this candle if you want, but it's right there, 86.80. It's right there. And then above that, there's nothing. So that's why it's dangerous. If they can hold 84 here, they have the opportunity to take that out and get to 89, if not 90, eventually, in the series of lower highs and lower lows. I mean, higher highs and higher lows, just like they've been doing. They continue that trend higher. So, but they need to hold 84. All right, folks, this is about it. It's a boring story, just like the SPY or the SPX, up and away. And we have it. We haven't had. This is crazy. Every time I look at it, I giggle. I giggle. 16%. 16% in a pretty good fast period of time. Let's see here. 53 days. That's a lot. And no red days. The last red day was December 6th, and here we are, 19th. 13 days ago. This one, I argue, is not red. It's a complete doji. And they open and close about the same place. They loved it and they hated it inside of that. So it's an indecision point in time. And we've had nothing but red. I mean, green. Whew. Good job, bulls. I'll see you later.